This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 4 videos on scalping. I'm going to be talking about scaling in and how it can increase your probability. Whenever you increase your probability, you always increase your risk. Next, I'll move on and talk about why beginners scalp. And the answer is because they tend to only think about risk, and when you scalp, your risk is small. But what beginners ignore is probability, and they need a very high winning percentage to be profitable. And that's a very difficult thing to accomplish when you're starting out. We have a trading range here, a weak sell-off, let's say a trader were to buy at the prior low, betting that the trading range would continue. It doesn't matter position size, 10,000 units, 1,000,000 units, 100,000 units, does not matter. Let's say his intention is that he believes he's going to make money by buying this low and adding more lower. He has different ways to do it. He could buy with a fixed number of pips down, 10 pips lower, for example, or he can buy on a reversal up. And how much should he risk? Probably, if he's trying for a 10 pip scalp and he's looking to scale in lower, he should probably risk about 30 pips or so, about 3 times the size of the minimum scalp. In the Forex markets, traders should not be trading with an intention of making less than 10 pips. Now, if you are adding on lower, in general, you want the second entry to be at least the size of a scalp below. So the minimum scalp size is 10 pips. So if you're planning on adding on, you have to be adding on 10 pips lower. And the reason is you're trying to make a scalp. The minimum scalp is 10 pips. So if you buy here and buy more 10 pips lower, let's say this is 10 pips lower, and you look to get out at your original entry, you get out break even on your first trade, and then with a 10 pip profit on your second trade. If a trade immediately goes your way, there's no need to scale in, you simply take your profit. Here's another example. You're buying a higher low, hoping for a higher low major trend reversal, but you're feeling confident that the bear trend will not be particularly strong. Looking at the price action here, bad follow through on the way down, pretty good buying here, and pretty good buying here. So you're betting that the market is going to be in a trading range rather than a continued bear channel. So maybe you buy here on the reversal up, and you place a limit order to buy more 10 pips lower, and then you place a limit order to get out at your original entry price. So you get out break even on your first trade, and with 10 pips profit on your second trade. Another example as well here, but this is over here, what I was saying about if you buy and the market immediately gives you your 10 pip scalp, does not go against you enough to add on, you simply exit and take your 10 pips profit. Here's another example. You got a second entry buy, first entry above this bar, second entry here. You're willing to scale in lower, but instead of going down, it immediately went to your target, so you can take your profit without having to scale in. Let's say you're a bear, and you're betting on a trading range or a weak bull trend. Either case, you can sell at a prior high. So you sell here, and it started to go your way, but did not fall far enough to make a 10 pips profit. Assuming you held on to your position, confident that you would make a profit, you look to scale in at least 10 pips above your first entry. And that would get you short a second position here. So if you sold 10,000 units here, you sell another 10,000 units here. And you look to get out break even at your original entry price right here. Break even on this entry, and then on this sale, you make 10 pips. And again, if the market immediately goes your way, there's no need to scale in. So here's another new high. So you sell there, and you're willing to scale in higher. If it immediately gives you your 10 pip scalp, you simply take it and don't worry about scaling in. And again here, another new high. Selling new highs has been profitable, so bears will sell the high. They're willing to scale in higher if it continues up, but if it immediately gives them their 10 pip scalp, they take their profit. Now, when you look at this, you say, oh gosh, that's pretty easy. In one session, I can make 4 or 5 scalps, but it's actually very hard to do. If you think about it, you're averaging only about 1 scalp per hour, and you have to watch carefully to get the exact entry. You need a really good entry if you're trying to make a 10 pip scalp on a day where the range is not particularly big. And it's difficult to catch every trade. Even things like this that seem obvious, they're really not that easy to catch. It's hard to sit there for an hour or more when nothing seems to be happening. So it's very easy to miss a lot of trades. Also, it's very easy to make a lot of mistakes. And the mistakes quickly erase everything good that you did earlier in the day. Let's say this is the session that you're trading. Usually during a typical session, the market might have 60 to 80 bars where the range is big enough and the bars are big enough so that you have a decent chance of making a scalp. An average session has, in general, about 5 reasonable 10 pip scalps, and it usually has at least one 20 pip scalp. Sell, take profit. Sell, take profit. Buy, take profit. The average session also has at least one 20 pip scalp. So buy here, that's 20 pips. Buy here, that's 20 pips. Sell here, that's 20 pips. Some sessions have many more than this, but this is fairly typical. I'm showing you a lot of trades during this 60 to 70 bar session, but there are many others that I did not show. And a lot of them you exit with less than 10 pips profit. A lot of them you'll end up with a small loss. So you lose 4 or 5 pips, 7 pips. You make 4 or 5 pips, 6 or 7 pips. Late in the session, you often start to find dojis and bars starting to go sideways, and the range of the bar is getting smaller and the body is getting smaller. The market ends up in a tight trading range. This is especially true at the end of the US session. A lot of the bars are only a few pips tall, even if there are 2 hours left in the session. Once the market starts to do that, it's very difficult to make money, and you should not trade. You should just wait until the next trading session. In general, most traders should start out looking for swing trades. But some experienced traders, all they do is scalp, or they primarily scalp. And why do experts like scalping? Because it has the greatest profit potential. Obviously, in a really strong trend day, you're going to make more money swing trading probably, because if you're scalping, you're in and out, you're in and out, you're in and out. You probably will not take all of the setups that are there, and you'll end up making less than a person who was swing trading the entire day. Greatest profit potential, yes. And the highest chance of making money every day, yes. But it takes years of experience to become consistently profitable as a scalper. And it also has to suit your personality. Just because somebody else is scalping doesn't mean that you have to scalp. It has to be something that's fun to do. It obviously has to be consistently profitable if you're going to do it, but it has to suit your personality because you're looking to do this forever. And one of the reasons you're drawn to trading is it's fun. So if you're trading and it's not fun, you got to change your style of trading. And most people would not enjoy scalping year after year. And most people would have a hard time being profitable doing it year after year because your winning percentage has to be so high. I want to make an important point here. I was talking about bar sizes. Take a look at these average 5-minute bars. This is a 5-minute chart. Most of the bars are less than 10 pips tall. Every 2 or 3 bars, if you look at groups of 2 to 3 bars, they're 10 pips tall. If you look at 2 or 3 bars in a row, the range of 3 consecutive bars is often 10 pips tall. This is a fairly unusual day because there are a lot of bars that were at least 10 pips tall. Now, why am I making this point about 10 pip tall bars? Every bar that's 10 pips tall, there's the potential to make a 10 pip scalp. And the more bars that you have that are 10 pips tall, the more chances you have to make 10 pip scalps. I'm drawing a contrast here between Forex markets and the E-mini. On the E-mini chart, for example, an average 5-minute bar on most days is more than 4 ticks tall. The minimum scalp on the E-mini is 4 ticks, 1 point. And if most of the bars are more than the size of a minimum scalp, you can have lots of scalping opportunities. So an average day session in the E-mini has 81 bars, and a really good trader usually can see maybe 40 good scalps. So on a day here where I see 10 or 15 bars that are 10 pips tall, usually I can see at least half that many good 10 pip scalps. So if I see 10 bars that are 10 pips tall, I can probably find at least 5 good scalp setups. Now, in this video, I talked a little bit about scaling in and probability. Scaling in, the reason why traders scale in is to increase their probability. And if they're getting something beneficial, they have to pay for it. There has to be something in it for the institution taking the other side of the trade. And you pay for high probability with worse risk reward. Now, why do beginners scalp? They scalp because the risk is smaller. They're going for a smaller profit. Their stop is closer. Unfortunately, they lose money by reducing risk because they need an adequate reward and they need a high probability. Anytime you're going for a trade where you're not risking very much, you're going to get stopped out a lot. So it takes a lot of experience to be able to make money with low risk trades because you need a very high probability. Very good scalpers can win 80 or 90% of the time. And very few good traders want to scalp. Most traders make more money by swing trading. I talk about my 90% rule every now and then. On any chart, you can assume that 90% of the bars on any chart are either in a trading range or in a channel. And when that's the case, you can make money buying or selling at any time on the chart. You can make money buying up here if you scale in and manage your trade correctly. You can make money selling down here or at least avoiding a loss if you manage your trade correctly. But that is a big if. You have to manage your trade correctly. And usually it involves scaling in, and that increases your risk. But if you do it correctly, you more than offset that increased risk by an increase in probability. Take a look here. We're selling off. Small bars not all that strong. We have dojis, bull bars, prominent tails, not a strong sell-off. So bulls will look to buy this. They'll look at it as maybe a high 2 buy setup, leg 1, pullback, leg 2, and a micro double bottom. So maybe a bull will buy above the high of that bar. Micro double bottom, down on this bar, up, and then down and up on this bar. So a little double bottom there. And maybe he's going for a 10 pip scalp. Maybe his initial stop is somewhere down here. Maybe he's using a 30 pip stop and he's willing to scale in lower. So he takes the buy here and he may place a limit order to buy more 10 pips lower. And then he looks to get out break even on his first entry and with a profit of 10 pips on his second buy. Every 2 to 5 bars all day long. You can usually find some reason to scalp, but it takes a lot of practice to see that. Buy, and you scalp, buy and scalp, sell. You can sell here. You get a double bottom bull flag, you buy. Strong bull breakout, you buy. Micro double top, reversal down, 3 pushes up, 1, 2, 3. Failed breakout above a double top, breakout, so 3 pushes up, 1, 2, 3. Does not look like a wedge, but it functions like a wedge. You can look at it as 2 legs up, 1 pullback, 2. Micro double tops, you sell there. Consecutive bear bars, you sell. Big bear breakout, you sell. 6 consecutive bear bars, first reversal up, probably will fail. So you sell above the high of that bar. Another weak looking bull flag, so you sell above the high of that bar. And then you start thinking, well, maybe a trading range. So traders start to buy below bars. They buy below the bull bar, they buy the new low, they buy the reversal up. Nobody takes all of these trades, but a great scalper takes a lot of them, and he's looking for trades every bar, every 2 or 3 bars. A lot of great setups do not make 10 pips. That's your minimum scalp size. That's your goal. And you have to be quick to make decisions. You have to make good management decisions. Now, taking all of these trades, it's manual high-frequency trading. So it's what high-frequency trading firms do with their computers. They're not going for 10 pip scalps for the most part. They're going for 1 pip, 2 pips, 3 pip scalps. And if you're a computer, you can do that. But as a person, I think the minimum scalp that you should try to get is 10 pips. And you're trying to do manual high-frequency trading. Again, really difficult to do profitably, consistently, year after year. And this is not the kind of trading that most traders should do. Now, traders should not be scalping for less than 10 pips because the math is just too hard. You got the bid-ask spread, you're going to make mistakes, fills are not as good as you want, and it becomes really difficult to risk 20, 30 pips to make 10 pips because you have to win more than 90% of your trades. And most great traders cannot do that all day long. Some great traders can, but most great traders cannot do that long term, year after year after year. Also, most traders do not find it fun. Beginners are drawn to scalping for one reason: risk. They're afraid of death of their dream of being a profitable trader. They don't want to lose their account. And the one thing they tend to focus on is risk. Oh my gosh, I worked so hard to get this money. My wife will kill me. My husband will kill me if I lose this money. They're letting me trade with this small amount of money and nothing else. And therefore, if I lose this money, my dream of being a trader is dead. Because of that, all I think about is risk. I cannot lose. I cannot afford to lose. I got to win. However, as a trader, you cannot think simply of risk. There are 3 variables that you always have to consider: risk and reward, and then probability. And unfortunately, ignoring probability is critical because if you're going for a small reward, even if the risk is small, you still need a very high probability. And that means you have to be able to find really high probability trades, and you have to be able to manage them correctly, which usually means scaling in. And that's far beyond the ability of most beginners. Trader's equation, you need 3 variables: risk, reward, and probability. And you have to structure a trade that makes sense. The probability of winning times your expected reward has to be greater than the risk times the probability of losing. And if you ignore any of those 3 variables, you're going to lose. You have to be thinking about all 3. I talked today about scaling in and how it can increase your probability, but it also increases your risk. Next, I moved on to talk about why beginners scalp. All they think about is risk because they're so afraid of losing their dream of becoming a profitable trader. And risk is what frightens them and concerns them the most. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 4 videos on scalping.